What's up, Banter fam? In today's show, I'll be showing you my ultimate bear market survival guide, the strategies that you can be implementing to not only survive this market, but come out the other side in an even better position. I did a thread yesterday which blew up on Twitter, and I think that it had some really valuable points that I want to expand in this video and give you an insight into my thought process behind the thread. I think it's going to be an awesome show. I think the content in this video is really valuable. So the fact you're here is awesome because I think this is something that you need to hear. Let's get straight into the show. I want to start off by saying thank you guys so much for 100K on Twitter. It's a really awesome milestone for me to hit. I mean, 6 months ago when I first started posting on Twitter, seriously, I never thought that 6 months later I'd have 100K followers. So I just wanted to say thanks to each and every one of you who follow me on Twitter, follow the content, follow the threads. It's truly appreciated. And yesterday on my Twitter, I did what I think was my most important thread that I've ever done. It was a thread on surviving a bear market, but more than that, actually how you can continue to profit in downwards markets and set yourself up for success. It's a very difficult market at the moment. I'm not shying away from that. Myself, I've taken a big hit over the last couple of weeks. And I know that a lot of your portfolios are hurting, but we can actually benefit from this. And as tough as it is, we're actually going to come out the other side even stronger. And I'm going to give you the roadmap, the exact strategies that you can implement to come out the other side. And I'll be covering my thoughts on the market and everything in today's video. I think it is really important stuff. So let's just get straight into it. This is the truth, guys. Millionaires are created in bear markets, not bull markets. If we look at throughout history at the people that have profited the most from crypto, the main people that made life-changing gains in 2021, they did so because they were the ones buying during the 18 to 2020 downtrend. The ones that made huge profits on Luna, the ones that made huge profits on Cardano, DOT, Chainlink during that period, BNB, which exploded, those people profited because they were investing during this bear market of 2018, 2019, and even 2020 after the March dip. So investing during a downtrend is the best way to profit in crypto. As much as people love to ape in during a bull market, it's actually much more profitable to be investing in bear markets. So let's look at some ways that we can actually do so. Firstly, guys, your focus should be on surviving and accumulating. When the market is falling, when we have massive crashes in the market, don't try and catch a falling knife. Your focus should be on surviving, accumulating, farming, and setting your portfolio up for success. So I actually did some example bear market portfolios here. Now, I'm not necessarily saying we're in a bear market in this video. The charts are suggesting that there are still levels of critical support that we are sitting on that indicate to me that it's not soon enough to come out and say we're in this crypto winter. Times are very different from 2018. We haven't seen institutional adoption like this in a long time. We haven't seen the amount of growth that's happening in DeFi and the user growth that we're seeing on chain in a long time. So the market is very, very different from 2018. So don't get me wrong. But I do think that it's important to have a plan B and have plans for both a downwards market and an upwards market. So this portfolio is one you would implement in a bearish market when market sentiment's down, and something that you can kind of stick to that's a little lower risk than our typical degen portfolios. Now, I'm not saying my portfolios look like this, because they certainly don't. I'm certainly a lot riskier, but that's a personal choice that I've made based on my goals. But these are the portfolios that I created and portfolios that I think could serve you well during a time of market volatility. So we've got the low risk portfolio here. This is 40% in stablecoins. Bitcoin, Ethereum, and Solana, Luna, and AVAX are all coming in at 5%. So this isn't me saying you should build these portfolios, but I'm giving examples on portfolios that I think could perform well or at least mitigate damage during a bear market. My medium risk portfolio is 30% in stablecoins. This is closer to what I personally like to stick around. I like to stick around the 30% range. And it's got Bitcoin, Ethereum, and then it's got these big blue chips, Solana, Luna, AVAX. They're too big to fail, in my opinion, at least in the short to medium term. And long term, obviously, we've seen some major developments coming in underneath these chains. So these are the three chains that I think are very cemented and their ecosystems are very, very promising. And more than promising because I think they're too big to fail with their backing. So I consider them blue chips. And then you've got your Phantom, Runes, and Arweaves, which are amazing projects. But those three I would consider medium risk just solely based off market cap. And then your higher risk portfolio, this is a lot closer to the portfolios that you're probably holding. I know that this is probably less riskier than what I'm personally holding, but it is a portfolio that could serve well in a bear market. That's having 25% in stablecoins, having Bitcoin, Ethereum constituting 35% of the portfolio. And then you've got the 3 blue chips, the 3 medium risk profile picks, and then you've got some gaming projects as well. So these portfolios are ones that could potentially serve you well in a bear market. Now, the projects I just outlined are interchangeable. The point of those examples is more to give you an idea for the percentage weighting. So if you don't like Solana and you prefer, I don't know, let's say Cardano. I don't know, if you're a Cardano maxi or you like XRP, then obviously you can substitute it out based on what you like. If you don't like Gala and you prefer PYR, you can substitute it in. So that's not me saying they're the best projects. That's more just to give you an idea of the percentage allocations that you should be using. And your focus should be on having percentage weightings which mitigate downside risk, but also give you scope for growth. That is very, very important. Now, your risk is your risk. The risk tolerance that you define is based on your financial goals, based on your crypto exposure and personal conviction. So if you have a large disposable income and you're not so worried about losing money, then of course you can have a riskier portfolio. But that's a decision that you have to make. If you're overexposed to the market, and let's say your portfolio halves, and that's going to significantly hurt you in your lifestyle, well, maybe you're overexposed, and maybe you should look at a safer portfolio. So money in crypto, is money that you kind of have to accept that it can drop 70, 80, 90%. Like, I'm not naive to this. And we all have to be prepared to take losses. I've taken massive hits on my portfolio, but I've said since day one that I was prepared for that because that is my personal strategy. If you're not prepared to take losses, maybe you need to tweak your strategy based on your goals and risk tolerance. So have a good hard think about what your risk tolerance actually is. Now, the most important thing is obviously having a stablecoin position at all times. And this mistake is a common one in crypto. And it's one that I want to kind of give my logic behind and explain to you how to actually go about accumulating stablecoins. So you're never in a position where you don't have money to buy the dip. So a lot of you probably struggled during this dip or are struggling because you don't have enough stablecoins. Now, it's a position that I found myself in multiple times in the past. I didn't have enough stablecoins. I was a bit too rash with when I decided to DCA. And oftentimes I put myself in a position where I didn't have enough money to buy the dip. So this is exactly how. These are 3 ways how you will always have money to buy the dip and you'll never have to worry about having enough stablecoins ever again. These are the 3 ways. Taking profits on holdings during pumps. So if an investment doubles, you can take your principal out. Then you're riding risk-free, essentially. That is one way to kind of manage things with your riskier plays. With your safer plays, if they pump, skim some profits on the top. Take 5, take 10% of your Solana, your AVAX, these safer projects, if they're pumping, and put some into stablecoins. Because you never know when the market is going to dip. And the market often dips. That's the law of crypto. What goes up often does come down in this market eventually. So taking profits during pumps allows you to always have stablecoins. So if you weren't taking profits in the last rally, my major message here is make sure you take profits during the next rally. We saw that rally up to 45,000. A lot of people were screaming for a new cycle. I admit I was getting bullish myself, but in the back of my mind, I was thinking, if we do come down, now's probably a good time to take profits. And I did take some off the table then. So you guys have to make sure when the market's pumping to de-risk a little bit. So I personally take 50% of my profits into stables and the other 50% of my profits into Bitcoin because that is my strategy. I have long-term conviction in Bitcoin as being an amazing store of value. And I see Bitcoin as a safer investment, in my opinion, than holding fiat currency due to inflation long-term. I want to stack Bitcoin. So I put 50% of my profits into stables and 50% into Bitcoin. That's a strategy I go with. But obviously, now that you have some stables, once you take profits during pumps, you need to know where to deploy them so you can earn yield on them. I mean, what is the point of keeping stablecoins or assets for that matter sitting in your wallet, gathering dust, when you can actively be earning yield, right? Because you need to be generating more stablecoins, generating more currency so you can actually come in and take advantage of these dips. So here's 3 options that I'm giving you. You've got Anchor Protocol, obviously. It's a staple of my portfolio and it should be a staple of yours. You've got stable pools across Phantom, which is still paying crazy yields, like 35%. You've got AUST looping on Planet Finance, who are an official show sponsor. That's paying 30 to 40%. And then you've got Platypus DeFi, which is paying 20%. But I wanted to make it easy for you guys because I know a lot of you don't have the time or necessarily the expertise to go through all these looping strategies because it can get a bit crazy. And there is risks involved, obviously. So I created my own copy farm on Donkey Finance. There's a link in the description. If you want to copy my stablecoin farming strategy, I kind of put this strategy into an actual farm where you can just deposit BUSD and you'll be automatically executing the strategy across Anchor, across Planet, across Beefy and Beethoven. And we go in every week and we adjust this based on the best yields. I think right now it's paying 30 to 40% APR. This usually sits around 27%, but we timed one of our pools really well. We got into this USDB DAI pool, which was paying 100% like the day it came out. So the benefit of copying a farm like this is that you get auto compounding, and you're going to see you're going to see us adaptive and change strategies based on where the best yields are. But there is smart contract risk, of course. So make sure that you're not putting in money that you can't afford to lose. All right. So that is the stablecoin. And then my third strategy here is via leveraging DeFi yield. So when you're yield farming, and this is a very important thing to note, when you're yield farming, you're going to be earning rewards. So let's say you put Luna into a farm. Let's say on Prism Protocol. Let's say you're making 40% a year on that Luna. Now you've got a couple choices. You can reinvest that 40% back into Luna and really speed up your Luna accumulation and compound Luna. Or you can take a percentage into stablecoins, which is going to allow you to continuously build your stable position whilst retaining the benefits of earning yield via yield farming. So I came up with 3 strategies for you guys because you should be taking more money into stables at certain points in the market. So when the market is bullish, when the market is bearish, so when the market is extremely bearish, people are scared, that's when you should be converting your rewards back into the base LP. So if you're staking Luna on Prism, when the market is bearish, this is when you turn bullish, hence the bullish logo in the corner, and start recompounding that Luna to continuously stack when the market is low. When the market is pumping, so price is going crazy, Luna skyrocketed, it's $120, and you've got money in that farm, then you want to be taking a set percentage of that investment. I usually suggest 50% and putting that into stablecoins to lock in profit. So when the market is bullish, that's when you flip bearish, hence the bear sign in the top corner. And that's when you want to be locking in some stablecoin profit. Now, when the market is mixed, and I'd argue we're kind of mixed at the moment because there's not a lot of clarity around whether, what Powell's going to say in his next speech, what the Nasdaq's going to do on Monday. It's extremely volatile right now. I'm not necessarily locking us into a bear or a bull trend right now. So if the market's mixed and you're not too sure where we're going to go, then you can do a bit of both. So you can put 50% of your rewards into stables from farming and then 50% into UST, Bitcoin, something safe to take profits. So those are the 3 strategies that I use to skim profits off my LPs. And if you do all 3 of those strategies that I just showed you, you'll never run out of stable coins again. You're taking profits when the market's going up. You're farming stable coins. No matter what the market's doing, you're earning more stables. And you're taking profits from your yield farming, a percentage of those profits back into stables. How could you ever run out of stable coins if you diligently stick to that? And that is the hard part. I admit being consistent and sticking to that is the hardest part because we get greedy. There's times in this market where we want to ape. There's times when the market's pumping and that real greed sets in and we want to veer from the strategy. But once you set a strategy, stick to it. I set a strategy, a personal investment strategy. And for the past month, I have stuck to that like glue. When the market was pumping, I was taking profits even though I didn't want to. And when the market was dropping like it is now, I've been doing a bit of DCAing because that is my rule. That's my personal rule that I've come up with. So create a plan and stick with it. And if these graphs can help you create a plan, then that's amazing because that's potentially something that can help you guys out stick to a plan too. All right. Here's the biggest alpha in this entire video. Passive income. Passive income is crucial. It is the most important thing in crypto that not a lot of crypto influencers are telling you about. And I think that aside from profit taking, it may be the most important part of crypto and part of managing a portfolio. Now, there's 2 forms of passive income. The one I talk about a lot on the show is DeFi yield farming. So passive income from crypto is great. I mean, it means that if you're farming your tokens, when the market is down, you're actually accumulating tokens at lower levels. So basically what's happening is, let's say the price of AVAX crashes. like it has from 120 down to $60. You're now farming AVAX at a lower level. So you're accumulating double the amount of AVAX tokens than you would be when the market was bullish. So you're accumulating more when the market's low. And this is why farmers love bear markets, because they get to accumulate more tokens at lower levels. This means that when prices recover, there's a twofold benefit, because they're stacking tokens when prices are low. So when prices recover and the market turns bullish again, they've got more coins that they've been accumulating whilst the market is low. So they actually profit twofold. They profit from obviously their baseline holdings, and then they profit the additional yield farming, the tokens that they've farmed, so that when the market pumps, they're making even more money. So this is why yield farmers, and I'm one of them, and I know a lot of you are one of them as well. This is why farmers love down markets. You should actually be relishing the down markets, because this is giving you a chance to farm at lower levels, and you'll make a lot more money that way. And this is the second major part of passive income that no one's telling you about. I don't know why, but a lot of crypto content creators, they want to neglect this. And I want to be totally transparent with you guys right now, because it's what's built my portfolio. It's what's helped build my portfolio. And I think it can help yours as well. And this is passive income from outside crypto. Now, it's a topic that's a bit taboo in crypto, because influencers want to sell you the dream of being able to make money purely from yield farming. And yes, crypto yield farming is amazing for making passive income. It's amazing. I do it every day. I make great profits off it. But this is the other component of passive income that's super important, and it's income outside of crypto. You should be optimizing your income outside of crypto to basically be able to have that continuous flow of income from outside the market. So if you have a consistent flow of income outside the market, you've got buying power to take advantage of dips. If the market's dropping, you're not worrying, because you're making more money. So you have more buying power to come in and take advantage of dips. So if you increase your income outside of crypto, that increases your buying power. And then this enhances your gains during the bull. Because when the market pumps, you're going to have accumulated so many more tokens with the excess income that you were able to generate. And you'll end up a lot further ahead than the people that were neglecting this. So there's a few ways you can do this. And I'm going to be honest, this is hard. This isn't easy. And it's life basically. Money isn't always easy to come by. So there's a few things that I think you can do to start optimizing your net income. This is firstly by starting a side hustle. You guys may not know this, but before crypto, I had multiple side hustles. I did drop shipping for a little bit. I started a marketing business. I did some music promotion. I did multiple things before crypto, and I'm going to do a video on this later, and the side hustles that I started before crypto later, because I think it's a bigger topic. But basically, I didn't just start in the market. I was actually optimizing my income outside of crypto, so I had more buying power. So I had more money to put into crypto, and that's why I saw some great gains, because I was able to really invest heavily when the market was low, because I had that source of income coming in. So optimizing your net income via a side hustle or a new business, or progressing in your current career, your income outside of crypto is so important to keep nurturing that. Stocks and real estate is another great thing to get into. I think I got into stocks like a few years ago, and that's been some of my biggest returns ever. And it gives me passive income. I'm earning dividends off my shares, which is cash that I can either put back into stocks or put back into the market. And I know this isn't for everyone, because it does there's a big barrier to entry. But if you can get into real estate, eventually, one day, maybe with your crypto gains, then that's also a great form of passive income. But I know there's a barrier to entry there, so it's not applicable to most people. And then obviously you can cut expenditure. If you're spending too much money on your lifestyle, if you're going out for too many dinners, buying shoes, buying a new computer when you don't need one, maybe that's the type of income you can start saving. Maybe you can cut your expenditure so you have more available capital. Disposable income is everything in crypto. And that's what influencers won't tell you. And I'm telling you today because I think it's so important. And you're going to be able to generate a lot more gains in the crypto market if you're making money outside of crypto as well. But both is equally as important. I don't necessarily want to go out on a limb and say that outside crypto is more important, because obviously yield farming in crypto can make you amazing gains like I'm doing, like Hustle's doing. But I do think at the same time, you have to pay attention to both. Now, if you're passionate about crypto, here's the thing. There's actually opportunities in Web3. It's not just a limited generating money outside of crypto isn't just limited to like another field. You can actually generate money inside of crypto. If we believe Web3 is the future like I do, I think that there's a massive opportunity to build a career in Web3, guys. There's so many jobs. The DeFi Edge said 4 years of studying university can get you a job. The truth is 4 years of studying Web3 can get you financial freedom. You can make a lot of money in this industry. So don't fade the importance of sticking to the process and continuing to educate yourself in this crypto market. There are jobs there, guys. There are lots of jobs. I've been speaking to owners of projects. I've been speaking to content creators. A lot of them are begging for jobs right now. I'd say there's a shortage overall of quality employees in Web3. And there's a huge gap in the market for you guys to make gains there. If that's what you want to do, if you want to take your career in that direction, there's a massive opportunity there. And people obviously forget when the market's bearish. And I don't know why they do this, because it completely evades logic, in my opinion. But when the market's down, that's the time to be dedicating yourself. It's not the other way around. The bear market is grind season. This is the season where you want to be investing your time and effort into crypto. The bull market is chill back and relax season. If you put in the hard work during the bear market, you can sit back. You can relax. You can chill. You're making profits. All you need to do is come in, take profits. You guys set up your entries from the bear market. You set up your entries. Now all you need to do is simply relax. Bear market is grind season. Bull market is chill and take profit season. Something so many people forget. But your effort should actually have a reverse correlation with the price. You should be putting in more effort during a bear market than a bull market. You should be putting in less effort during a bull market. For some reason, everyone has this twisted. They get demoralized when the market drops, and they kind of space out and they go, oh, it's making me too depressed. I don't necessarily want to pay too much attention to it. But it should be the opposite. This is the season to grind. When the market's dropping, that is when you double down. I'm doubling down. I'm working crazy hours. I'm diving into Web3. I'm diving into new projects. I'm speaking to projects. I'm doing a lot now because I know that when the bull market comes and we get that raging bull again, which is inevitable in my opinion, that the people that put in the effort now are the ones that are going to come out ahead. So what's some practical advice for learning? Because not everyone will give you practical advice. They'll say, dedicate yourself. But, where do you even start? There's a lot of places you can go. The place that I would start is Discord. I learned so much of Discord, Telegram groups. But more importantly, creating your own research groups, scheduling regular calls with those members, discussing ideas in the market is the best way to grow. It is so much easier to learn about this market and not only learn, but stay loyal and stay committed if you're learning with others. Collaboration's key in life. Humans are built to be social creatures. We're not built to operate in isolation. It's in our biology. It's in our blood. Much easier to learn with others than it is alone. Create that research group. Reach out to people on Twitter. Get into Discords. Talk to people. Really better your own knowledge, but more than that, push each other and start joining and scheduling research groups to discuss the market. I recently just bought a Neo Tokyo Season 2. The price has crashed. People are asking me, why on earth would you buy a Neo Tokyo Season 2? It went from 11 ETH to 1 ETH. I bought it for the connections because you can actually build something special. There's people, like-minded people in that group that you can build a connection with and really be on the forefront of crypto gaming. That's why I joined. That's just one example. There's multiple Discord groups. I actually have a Discord. It's a link in the description. My Discord's great. If you guys want to learn about crypto and talk to people in DeFi and connect with each other, I'm on my Discord every day. So come and join. Link in the description. Start making connections and start collaborating. I think it's so, so important. All right. When to buy? I know you guys probably want this. I'm getting a lot of questions in the comments. Everyone's like, when should I buy? Should I buy the dip? Should I sell? I'll give you a little bit of a take on this now. Now you've got stables. Now you've got your research group. Now you've got your income. You're all set. You're following all the steps I just showed you. The question is now, when do you buy? Firstly, don't catch a falling knife. Don't try and ape into the market when it's dropping and it's going downwards and there's a massive red candle. DCA. I can't stress this enough. DCAing is the only consistent method in crypto to achieve sustainable long-term success, in my opinion. DCAing is what got me where I am today. DCAing is what all the top investors will recommend you. Unless you're a trader and you actually have a massive skill in trading like a Sheldon does or a Kyle does, they flip in and out of the market because that's what they do. If you're an investor like me, and I'm sure a lot of you are, then the safest method is to DCA. This means over time, put in little amounts. Have a regular system where you put in money every month. I know every single month I buy a little bit of Bitcoin, DCA through the market, guys. That is the best way to get your average buy prices down. Not all DCAing is created equal. I don't DCA consistently all the time. And what I mean by this is, let's say I have $100 and I'm investing $100 a week. I wouldn't be investing $100 a week every single week, even when the market's bullish, even when it's bearish. I would actually take a scaled DCAing approach. And what this is you ramp up your buys when the market is extremely bearish. So when you see these periods of extreme fear, that's when you start buying more aggressively. And when the market is extremely greedy on the other end of the spectrum, that's when you buy less aggressively. So if the market is crashing, you DCA a little bit heavier. And when the market is pumping, you're DCAing a lot lighter. This will mean that your portfolio skews towards lower buy-in prices. So you may be underwater on an investment in the short term. Let's say you bought the dip yesterday and the market dropped another 10%, which it did. Then yes, you'd be 10% underwater on that position right now. But if you continue to average in, then you're going to come to a position where your buy price averages out, and long term, you're in a much better position than the people that were buying during the pumps. So buy dips, not pumps, is the easiest way to simplify this. But I only deploy significant capital on red days. When crypto Twitter is capitulating, a week ago, I didn't think they were capitulating. I'm starting to see more signs of capitulation. When Twitter is angry and depressed and the views on YouTube are down and the Google trends are down, you can look up crypto on Google Trends and see how many people are interested. When retail interest is bottoming and it looks like it couldn't get any worse, that's when I deploy. I deploy on those extremely red days. I don't deploy significantly on green days. I will buy on green days little nibbles, but when I'm talking about significant chunks of stables, I do that on really red days. But make sure you're keeping 25% of your portfolio in stables at all time, at minimum. Right now in this market, we don't know if the market is going to keep tanking further or pump and rally tomorrow if power comes out and isn't as hawkish. It's possible it can go either way. So right now, don't risk it. Keep some money in stables. I just showed you 3 strategies earlier in the video to make sure you always have money in stables, and make sure that you always have buying power to buy these dips. There's nothing wrong with taking nibbles after smaller corrections. If the market drops a little bit and you want to DCA, you can DCA. You know, I'll never shun someone for DCAing into a quality project, but make sure you're keeping that cash in stables and have that focus on generating passive income. And that is my major tip for making sure you're taking advantage of dips. What am I doing at the moment? Well, I do have money in stables. I've got over 25%. So if we keep dropping, if the market goes down another 50%, if we do hit a true capitulation zone, then I won't necessarily be happy, but at the same time, I kind of am, because it means I can pick up cheaper coins. I have conviction in these projects long term, and I wouldn't be holding them and I wouldn't be buying them if I didn't. I bought some Phantom today. I bought a little bit. I didn't buy a lot. I didn't deploy half of my stables on Phantom. I didn't ape, but I bought a little bit, because I'm seeing the capitulation, and yes, it could go a lot lower. So could any of these coins. They could go to zero. Like, that is part of crypto. I don't think they will, by the way, but that is something you have to be aware of. But I'm still taking advantage of these dips when they come. I'm deploying when the market is extremely red, but I'm keeping enough stables on the side. So if we go true bear, I have enough money to buy the dips. And that is so important, guys. So I hope this advice can help you. I want to continue this conversation right now because I think there's so much more to touch on. This is such a broad topic. So on my Instagram right now, I'm going to go and I'm going to answer your live questions. There's a link in the description, or if you want to search it up, it's Miles_Deutscher. For the next 15 minutes, I'm going to be answering your questions live. I know you probably have a lot. So come over to my Instagram right now, link in the description. We can have a conversation about this market, and we can do a little bit of a Q&A, which I think will be great, because I can't cover everything in these shows because this is a massive topic. So come on down right now. Come over to the Instagram. Let's do a Q&A. I'll see you in the next show. Peace out.